Be led by Eric Savitz of Forbes. So stay tuned for a very stimulating, exciting discussion. I know with Eric moderating this next panel, it's sure to be very lively and controversial. So Eric, why don't you come up, and David Chen from VanceInfo, David Lamb from WestSummit Capital, David Williams from William Capital Advisors. Do we have any other Davids around? And also Valerie Leon from Asia Alternatives. This panel is about making the deal. We're seeing a lot we're seeing a slowdown in IPOs and a pickup in going private. We're also seeing an uptick in M&A and trade sales. So I'm going to let Eric take it away from here. Thanks, Eric.
Thanks, sir. I can just
yell. That'll work. I can say Dave. I can just say David a lot, and someone will answer me.
Yeah, David a lot. Actually, why don't you all scoot down one extra, so the podium doesn't hide their view here.
Okay.
Is that better for the people over here? Okay, good.
Okay, there we go. Well, thanks, Rebecca.
You, Eric.
Okay, so I'm going to have to think of a strategy here for how to say David and not know who the hell I'm talking to. So let's talk about a little bit about the sort of state of the market for Chinese IPOs. And let's start with David. We'll talk with David Williams. David, could you give us a little sense as from an investment banker's perspective, how do things look right now?
Sure. In terms of the overall perception of investor interest in Chinese IPOs, it looks pretty glum, at least when you're looking at the press. But over the last couple of weeks, we've surveyed quite a few hedge funds and other investors, and they're still quite interested in the China market, but it's selective interest. And so they're not scared away by all the scandals and all the wars with the short sellers and what have you. In fact, some of these investors are short sellers. What they're looking for are the companies that are growing fast enough to more than offset the perceived risk discount required for investing in China. And in particular, there are a number of sectors that are growing faster than the overall Chinese economy, and therefore they're less concerned about investing, given that whether the Chinese economy grows at 8% or 6% or what have you, these companies still should be able to earn their way to premium valuations.
So let's just take a minute to look backwards at how we ended up with a market where it is so difficult right now. Not what's difficult for anybody to come public, but particularly true for Chinese internet companies in the U.S. market. How did we end up with such a difficult market?
Sure. I would say there are a number of problems. One, which I think we talked about earlier, is all the backdoor listings that happened. And so a high percentage of them had problems with the underlying companies being merged into the shells, and they were ripe for the picking for the short sellers. And so with the success the short sellers had in shorting those companies and uncovering problems, they had a great deal of credibility. And then when they moved on to the already public companies that had gone through the traditional process of listing in the United States, wherever there was smoke, there was soon to be fire. And so they were able to drive down the prices of many companies that were quite good companies that had no problems. And so when you look to new companies looking to list right now, I wouldn't say that the challenges are meaningfully higher than they were a year ago, but you have to overcome some issues that have arisen in the last 1 to 2 years, and those relate to issues such as quality of auditing, growth of the overall economy, and then issues regarding structuring. And so investors are still willing to invest in Chinese companies with the VIE structure, which is indirect ownership, but the devil's in the details, and Baidu is often looked at as the gold star example for how to structure a VIE, and then there are companies, which I won't mention, which might be viewed as the opposite of that.
So I'm going to keep saying David and make myself laugh. David Lamb, could you talk a little bit about how your approach to the market has or hasn't been affected in terms of investing in the venture capital market in China, and how that's been affected by the change in the available exits for you.
Yeah, I think specifically related to IPOs, so just a little bit of background on our firm. We invest in both foreign companies, so companies for instance, in the US or in Silicon Valley that have products ready for the China market, and we help bring those companies in their growth stage of financing into China. Likewise, we are an active investor in China in the growth stage market there. I would say that it's actually impacted our investment approach quite substantially. Our general assumption when we look at investments in the U.S. is that they would go public or they would exit in the U.S. Our expectation for Chinese companies, likewise, is that they would exit in China. So we have stayed away from some of the structures that we've talked about tonight, and really focused on companies that, if they're successful, will stay within that country to really avoid some of the potential issues that may happen. You know, we're by no means experts in this field, so we don't consider ourselves able to predict when the market sentiment about China, which I think some of it is unfounded, but nonetheless is there. We're not sure when that sentiment will change. So in the meantime, all of our investments are really structured to exit in their respective home markets.
So talk a little bit more though about the advantage of and why you're thinking about that way, about exiting in your home market, why you want to, because there's been I don't know what the current number of Chinese companies listed in the U.S. is, but it's a very large number. Mm-hmm. It's interesting that your thinking is they should exit in China.
Well, I think generally it's all about, for us, it's all about valuation. So we see that Chinese companies that are listed in the U.S. typically have a pretty low valuation. In fact, we've looked at some take-private opportunities over the last several months because we see that as a huge buying opportunity. As far as a selling opportunity, we're much more cautious in terms of our growth stage companies in China that may have an opportunity to go public down the road. So we've really focused on those companies staying within their home markets, and I think it really has to do as well with just our general belief and our experience. Two of our co-founders started companies or took companies public that were Chinese companies and took them public on NASDAQ, so they have a little bit of personal experience with this as well. And I think again, our collective perspective is to really steer clear of those companies and those sectors that would force them to go public on the U.S. markets to achieve liquidity.
So, David, you're running a company, David number 3, David Chen. You're running a company that has done exactly what he's describing. You're a China-based IT infrastructure provider. Mm-hmm. You're listed in the U.S. You're about to merge with another Chinese infrastructure provider that is also listed in the U.S. Mm-hmm. Talk a little bit about your experience. You've been public for quite a while now, so it's a slightly different time frame. But talk about your experience as a U.S.-listed, China-based company and the advantages or disadvantages of being listed here rather than in China.
Okay, yeah, back then when we raised money from Silicon Valley VC, Sequoia Capital, DCM, I think they have given us a lot of support and also, established a good governance structure for our company early on. So that's lay a very strong foundation for us. And also, back then, the only choices for us to go public is still in the US. That's pretty much the only choices. And then luckily, in 2007, even though the economy is already slowing down in the US, but we still made the right choice. We decided to still go public. And then we have seen the up and downs. Basically, when we went public, we thought we can price as $12 to $15, but eventually the offering price, we went public on December 12th, 2007. Oh. Right, so eventually the offering price was 8.5, right? So mm-hmm. The board delegated the whole decision making to the management team. Management said we still want to go public because our business majority of them are from the global market. So in order to raise the visibility of potential customers or the market we're tackling, it makes a lot of sense to go public. And then at one time our stock went all the way down to $4, and then eventually, because we deliver consistent result quarter by quarter, it went all the way up to the $40. Mm-hmm. And then because of the Long Top scandal, all the kinds of the economic issues, etc., And then our stock eventually came down to $7 to $8, $10 right now. So we have seen those up and downs. But talking about what's the current assessment of being public or being private or whatever, I think we did a lot of thinking on these areas, because one of the choice for us is we take a company private, right? I mean, try to do our own and then see what would be the best exit. The other one
so when you get down to, your stock goes to $4 from $8.50, is that a time when you begin to think, wow, stock's cheap, maybe we should buy the whole thing?
No, actually, back then, $4, even though we were at the $4, but I think we still need to consistently deliver the result, because we haven't proved ourselves in the public market. So we think, give us some time to prove ourselves, and then eventually the stock price will eventually reflect our internal value, yeah. But let's say for the last year, we do have an option. Let's say whether we want to go public or, we still continue as a public company, or we can take the company private, or we merge with another one, right? So I think because the nature of our company, the strategic direction for our company is try to be the next generation global services companies. And if we take our company private and then try to go public, let's say in Hong Kong stock market, then it still limit our, the future, the vision. It doesn't reflect the vision for our company. So the current thinking for us is that we as everyone, probably many people already in this room know about it, we will merge with Highsoft, another leading IT services company out of China, another public company actually also. So the whole process was very cumbersome. Before announcement, I mean, we had a number of board meetings, right? Our lawyer, he came, flew all the way from San Francisco, sitting in every board meetings. And every board meeting, he had to remind us, what would be the responsibility as a board member, right? But I think we made the right decision for shareholder, for all the employees in our company. We merged the two companies so that we can shorten the time that we reach the key milestone, $1 billion revenues, so that we can compete on global basis. And also we have a much deeper management bench, so that enable us to grow our capabilities. And then we also need to take time, actually, 4 to 6 quarters after the transaction to prove that we can really deliver the result, drive cost synergies and revenue synergies. And then for us, I know that the Chinese concept has a lot of troubles these days, but I think there are some of the companies are sort of like penalized because of some bad apples, yeah. For us, we also try to move beyond the China concept, because ideally, we are a truly global company. Today, after the combined company, 1/3 of business from Greater China, and then 40% revenue is from US-based customers, 10% is from European-based customers, and the rest is from Asia. And Asia is the fast-growing sector for us. We're doing business in ASEAN countries like Thailand, Myanmar, Indonesia, Singapore, etc., and also expanding quickly in Australia market. It's a gold mine actually for us. So I think we see a tremendous opportunity ahead of us. So we'd like to move beyond the China concept for us. But after 6 quarters, we will definitely continue to evaluate different options. Yeah, do the best thing for the shareholders.
So one thing I'm curious about for your company is a lot of the discussion around Chinese technology companies has been around web companies, and a lot of those are consumer-facing, search engines, online commerce companies like that. In your case, it's a different story. You're serving enterprise customers. I wonder if in your case, having a U.S. stock listing is an advantage in the sense that your customers are probably a little more conscious of things like your corporate structure in a way where if I'm going to do a search on Baidu, I'm not thinking about who owns the company particularly, I don't think. Is that helpful for you to be listed here?
I think it definitely will be very helpful, because for us, even to expand the business, ironically, we start from a global business, and then we came back to China business, domestic business, and we become one of the largest IT services provider for the domestic banking sectors, the airline sectors, etc. Because I think as a globally listed company, I think give us a lot of, automatically establish a lot of trust relationship with our customers. And then it's also helped a lot for us to expand our footprint throughout Asia, and also be able to attract global talents. Yeah, so I think still it's a good thing, but maybe people just not satisfied with the stock price, right? It doesn't reflect, I mean, to me also, personal view, it doesn't reflect the intrinsic value, yeah.
Do you think if you look at the valuation of your stock relative to, say, the Accentures and IBMs of the world, the companies that you compete with, or do you get penalized as a Chinese domiciled company as opposed to being, say, based in, New York or something?
No, not necessarily. You mean when we compete against them?
Yeah, well, in terms of the way the investment community evaluates you.
Okay, I see, yeah. That's a very good question. It depends on the market we are targeting, okay? For Chinese market, it's considered to be home turf today.
Right.
So automatically we have advantage because
home field advantage.
Yeah, we keep gaining market share against all the other competitors, local competitors, global competitors. In fact, for the combined company, we do about $120 million just for the Chinese banking sectors. So automatically put us as number one. I mean, dominant number one. And then, but for the Asia countries, we also has a lot of competitive advantage. We compete against IBM, Accenture, Cognizant, and Infosys throughout Asia, actually. But I think we still have a lot of value can be provided to the customers. That's why we gain accounts like AirAsia in Malaysia. We work with Telstra in Australia, etc. We can effectively compete. I think, but for the long-standing market that we are serving, North America, European market, we definitely can do a good job for them for their operation in Asia. I'll give you an example, New York University, right? I mean, they're expanding, they're going to build a huge campus in Shanghai.
Right.
So who's going to be the best service provider for them? Definitely VanceInfo. Yeah. Similarly for
no advertising.
Staples, yeah. Similarly for Staples, right? I mean, it's a Boston-based office supply company, and they bought a company in China, and they try to grow aggressively in China, and then move to the e-commerce platform. So they can work with IBM, Accenture, or VanceInfo, but because of our unique strengths, we have a lot of developers throughout China. We know that we have the very intimate knowledge on the cutting-edge technologies. Also, we have the reliable processes and methodologies. So we were chosen to serve them, yeah. But we need to take a fresh look at how to really expand it eventually to the global markets, and also try to be more innovative, try to be able to attract different talents to truly form a global company, and that's still a challenge for us.
Valerie, we've neglected you down there. Because your name is not David, so we're gonna call you David. So David on the end, newly named David. Talk a little bit about, so your firm, you work at a fund of funds, that you do private equity and venture capital and all sorts of things. Talk a little bit about your perceptions about the state of the Chinese, not just IPO market, but sort of equity markets, and how your perceptions of the markets affect where you allocate capital.
Sure. So in terms of the venture market, I'll start there. What we're seeing, our very first commitment was actually to an early stage Chinese venture firm. And what we're seeing in our earlier commitments back vintages 05, 06 is there definitely is a slowdown. We did expect to see more liquidity, at this point. So bottom line, there's an IRR impact, but what we're hoping is that from a multiple standpoint, ultimately, that there won't be too much of a hit with the overall funds. So even though the valuations are lower, domestically, the IPO window is shut. We are encouraging our GPs to spend most of their time on the winners in their portfolios. So when the IPO markets domestically do reopen, that there will be that strength in the portfolio, and still again to maintain the multiples. On the public market side, what we've seen is from our growth capital managers in China, they're increasingly doing some open market purchases, but mostly PIPE transactions, again, because the valuations are very attractive.
So are you seeing companies go look at, if you have a company that needs to raise capital, it's relatively mature, in a normal environment, might choose to go public, either in the US or China, what options are they taking? Are they, can they go public in Hong Kong? Can they do, later stage private equity? What are you finding for those companies doing?
It's a matter, for us, it's a dialogue with our GPs about how to maintain the growth. And again, to my earlier comment about focusing on the winners, there are some, that just can't maintain the growth and also can't raise another round. The market in Hong Kong has also been extremely tight. So again, I think there's more bifurcation within the overall funds, the overall venture funds as a result.
David and Lam, what are you doing in your case we've got a portfolio of companies that either approaching what you would hope to be exit sized, are looking for ways to either find an exit strategy, find a liquidity event, or at least, if not, perhaps find another way to raise capital? Are they doing like late stage rounds? What's the strategy you're applying?
In China or in the U.S.?
In China.
I think in China, a lot of our investment focus there has actually been less on the B2C space for some of the reasons I mentioned earlier. We've been very much focused on companies in the hardware ecosystem. That's one area of keen interest for us. Reason being is that the manufacturing ecosystem for almost any electronics product in the world often runs through China. So we've been quite impressed with a lot of the companies there that are really competing against imports from Japan, imports from the US, imports from Europe and the like, and taking a cost structure that's very sensitive and leverages China, as well as a standard that is really at a global standard. So as a result, many of our companies that we have that are in China do have and meet many of the listing requirements for the China market. We have one company that's preparing for a listing, for filing in the first quarter of next year. And so they've been profitable for several years and have grown revenues substantially over that period of time as well. One of our newer investments is the same thing. They've been profitable for 3-4 years, but have really hit that inflection point in their growth. So when we're looking for, quite frankly, for those companies, we're looking for opportunities to invest more because of the challenges in the Chinese IPO market. This gives us an opportunity to put additional capital to work. And so and since those companies, as I mentioned earlier, are manufacturing real things, they do require working capital. They do require buying new tooling machines and all those sorts of things that companies need. So we've used that opportunity to step in and invest additional capital in those companies.
When you say making real things, are you talking about in the electronics market or other kinds of equipment?
So we're very excited about the mobile sector, which was discussed earlier today, and that entire mobile ecosystem for us. We've looked at companies. Really, we have an investment already in a company in the NOR flash memory space. That's the memory that does not require energy to store data, very common in mobile devices like tablets and phones, as well as in an optical zoom subsystem company in southern China, which has actually been selected by some Japanese customers, even though they compete very heavily against some of the Japanese lens subsystem companies. So instances where you're taking, and this flash memory company just replaced Spansion, which is used to be part of AMD, a big US company, as the 4th largest provider in the world for that technology. So in those cases, we're looking for companies that are, that have that, have some technology, but also are highly competitive and face an international host of competitors. And also some of our partners have been involved in various companies that are important parts of the ecosystem in the mobile space. So that's where we focus more on. On the software side, quite frankly, a lot of our investing has been here in Silicon Valley, because we do see right now a huge gap between some of the development of the enterprise software business in China compared to what you might see in Silicon Valley. So companies like David's are going to be very successful because they have Western DNA that's really driving their innovation. Likewise, we see opportunities for U.S. companies to expand out there. And so in those cases, that's really defines our software strategy.
Are there examples of Chinese enterprise software companies that have managed to become, significant players outside the domestic market?
That's a good question for David.
I think on the service side, we are living example, right?
Right.
So we are already expanding in multiple markets. But on the software front, actually, it's very tough because even, internally we said we are going to move to the non-linear model. Means we need to build a software upfront and also either licensing the software to the customer or doing as a SaaS model, right? But even for the Israel companies, when they move to the US market, they pretend as American company like Mercury Interactive Commerce, MDOC, all those companies.
Right.
They've done very successful. And then very few company from the other part of the world, like a Germany-based SAP or Business Object from France. They've been successful. So we are thinking about how we are able to do it. That's a big question mark for us to answer also. I don't know yet, actually. But we have our own airline solution, prototype softwares. We've been successfully selling to ASEAN countries, in Burma, in Macau. Macau is part of China, but it's still very independent, yeah. In other part of the ASEAN country, we are actively selling our prototype solutions. And those emerging companies, actually, they are very acceptive to Chinese solutions, actually. Because I think China probably will be a very good testing ground because you have a lot of affluent customers, and also you have extremely poor customers. So you can test all kinds of softwares. And also with the merging of the B2B to B2C, because I think the consumerization IT is going to create a huge impact to the enterprise computing. And then this morning, I also had a discussion with one of the former PwC partner. He's retiring and now he's writing a book about the social enterprise computing. I totally agree. He's thinking that enterprise 1.0 or 2.0 is all about how to align with the company's strategic visions and then also take an order from the top executive and implement the systems. But you can see the grassroots movement of the enterprise computing, Yammer or those companies, right? They acquire customers just like internet companies and try to convert those customers into paying customers, yeah. So I think you're going to see a lot of, put the human face on the enterprise computing, and then it's similar to like Renaissance in medieval ages.
Right.
So for the enterprise computing.
Right.
So I think the big wave is coming. I think there are tremendous opportunity over there. And how we're going to ride on those trends, we hope we can do something about it and try to create global impact. Yeah.
So I want to raise one of the questions that gets raised a lot as U.S. investors look at investing in Chinese companies, even U.S.-listed Chinese companies, is concerns about things like regulation and accounting standards. And there's a sort of an underlying, I think when you look at, say, sort of valuations and look at perhaps in some cases why maybe those companies don't get the same valuations that you do for a U.S. domiciled company, that there's concerns about the quality, say, of regulation and accounting standards, and their just ability to have transparency on what's actually happening at companies based in China. I wonder if somebody, maybe, I'll throw it open, looking just for some insights on whether that's a legitimate concern. Is that an overstated fear? Or is there a good reason to be concerned about that issue? David? And I was just asking anybody named David.
All the three
Go ahead,
David.
David Williams.
Okay. I'd say it's not over, there should be some level of concern, right? But it ebbs and it flows to extreme degrees in China. And so when I first moved out there in '97, and I was with Solomon Brothers, there was an attitude, I remember when we were trying to take a few internet-related companies public in the US out of India and China, and the reaction we got back in New York was, no way in hell, this isn't going to work. The only place that they do tech in Asia is in Taiwan, and it's dirty in Asia, and all sorts of things that made no sense like that, right? And they said, if you can take a company public, you've got to do it at a discount to the US comparable because of the risk in China, the country risk. But they failed to factor in the fact that if you've got a Chinese company that's growing at 3 or 4 times the rate of the US company, you don't value it at a discount. It happened many times, but then those companies rocketed up 2 or 3x within a year, or perhaps the same day. So what you need to do is value it based on a growth-adjusted multiple, and then subtract the discount. And generally, the discount, we track it by looking at Baidu versus Google as one example. The discount has ranged from as low as a negative discount, where it looked like the US was riskier during the financial crisis, to a 20% discount for China. But in any event, it swings back and forth, and right now, we're at the bottom, the worst that it can be, and I'd say that valuations right now, yeah, they're lower on average for US-listed Asian companies, but that's temporary. And if you look back over the last 10 to 12 years, it swings radically up and down. And so once we get going a little further along, and I think we've hit the bottom in terms of the scandals in China, you're going to see US, not just US institutions piling back into these stocks, the ones that are already listed in the US or high-quality IPOs, the ones with the right type of structures, which don't allow for easy manipulation of profits by management. And then you're going to see retail investors pour in again, like you do every time we have a cycle. And so within a few years, you're going to be seeing much higher valuations here in the US. And so right now, I think David Lamb's point was correct that right now valuations are tougher here. But in a few years' time, it'll probably swing way too far in the other direction. And it's just a question of when you have to do a transaction or whether you want to be on that ride.
Boom to bust. Valerie, what's your thought about this?
Sure. Well, wearing the LP hat, I mean, it's one glaring reason why we believe it's so important to be local. And when we're diligencing GPs, we prefer single country fund managers, again, because they're the ones that know the ins and outs of the markets and conduct that deep due diligence, right, that takes away some of the concerns that some of our investors have about the lack of transparency. And I absolutely agree, we're at a very low point, and sentiment comes in cycles, and when we're at a low point, that's also a good time to seek opportunity.
So, Rebecca, how are we doing on time? Are you over there? I can't see you.
We have about 5 more minutes.
Okay. Do you have any questions in the audience before we keep going? Yeah.
Yeah, hi. Actually, I had Asia for...
Oh, we have a mic. We have a mic coming over.
Please introduce yourself.
So my name's Brewer Stone. I had Asia for Pacific Crest. We've actually, just for what it's worth, we've done a fairly detailed analysis comparing valuation trends of U.S. subsector comps against the Chinese comps. And I think one thing that needs to be realized is that for many years, as I think David Williams someone pointed this out, the Chinese comps, often, and emerging market comps broadly, traded at a substantial premium, often 20–30% relative to, and you can see it, and you can analyze it by subsector. It was really across the board. It's really only in kind of August, September last year they started by and large to trade at a discount. That discount, it's varied between about 15 and 20%. I think David pointed that out, but it's actually been closing of late. And we've seen quite a lot of activity in the investor base and really starting to feel the bottom. A lot of it is tied. It's not just the scandals and VA structures and things like that. It's also broad concerns about China macro. People really don't, they really don't know where the bottom is. They hear lots of anecdotal evidence about declining, online ad spend and so on, and there's softness of demand. So they don't, when in a de-risking environment, they tend to wait until they see momentum in the right direction before they pile in. And we're actually seeing that trend shift fairly strongly. So, I think there's a little bit too much doom and gloom on the equity capital markets.
So is your question is, do they agree that there's too much doom?
Yeah, I guess I'm hearing a lot of it, and I wonder if you guys, that's more of a comment than a question, obviously,
Yeah.
But I would be interested in your perspective. If you guys, do you see a turn here, or do you think that's too positive?
Somebody want to take that?
Okay.
You're on the spot, David.
I'll make it easy. For the first time in a number of years, if someone were to lend me $1 million, okay, full recourse to myself.
Anybody want to lend David $1 million?
Do we hear two? I would invest it in the China market right now. I would not have said that 6 months ago. I wouldn't have said it 2 years ago, 3 years ago. So things look, I mean, I've seen some of the best teams where I know the teams personally, and the company's battered down. And so usually you do pay a premium for those companies.
When you say you'd invest in the China market, are you talking about you would invest in U.S. listed Chinese equities, or you would invest it in private Chinese
U.S.-listed Chinese entities. And the reason for that is that I believe that a U.S. listing provides a higher bar, and I'm more comfortable with companies that do that, as long as they have enough market cap to have the research coverage and so on. But when you're considering a listing, to everybody else's points, all I would advise is that you set yourself up so that you could consider a U.S. listing or a local listing, depending on your market and so on and the type of company you are. You don't have to go one way or the other, but once listed, I'm much more comfortable with U.S. listed companies.
Interesting. Anybody else want to weigh in on that?
Stella wants to lend money. She's a venture investor here in the audience from China.
If you want to give him more than $1 million, I'm
Yeah, she has more than $1 million to play with. Anybody else?
I'm not that confident. I'd go up to 2.
Oh, really?
That's right.
So maybe not so doom and gloom after all out
I
there.
think we have
Yes,
one more.
Liling? And just wait for the mic for a second.
My name is Wei Ling Li. I work for a U.S.-listed Chinese company. I hope you're right. So my question is that, well, the U.S.-listed Chinese companies are way down, stock valuations are way down, but the Chinese stock market is also way down. So is that out of sync? What are your opinions about it? Well, Chinese-listed companies, China-listed companies.
I'm happy to answer, but to give everybody else a chance. Do you want somebody else want to go?
David Lamb?
Okay. The problem with comparing the two, if you look at the China markets, is that if you look back a year or two, a lot of people were saying, look at the great valuations in the China market. Well, to some extent, some of those markets are closed, right? Sometimes there isn't as much liquidity, as much trading volume, and so it's really hard to compare the two. I'd say that generally, the China market right now, you're seeing individual investors there dealing with, for the first time in a long time, a decreasing growth rate, right? And it's not the growth rate that matters, it's the growth of the growth rate, right, that freaks people out. So I would say that it's also depressed. There's probably upside there as well. But once again, I just am more comfortable knowing that the companies have to do more reporting and are generally signing up for something, for a higher bar of governance, and therefore I believe that there's certainty that the U.S.-listed China companies are going to rise a good deal over the next couple of years. The Chinese companies will rise too, but they could rise a lot less. They could rise a lot more, depending on individual investor sentiment in China.
Any other question? Yes.
I'm Maggie Young from Bank of America Merrill Lynch. I would like to share a few of my thoughts on how I would invest for my client.
Okay, and also a question?
Yeah.
Okay.
My view is, how far can we go down if the valuation and the fundamentals are so attractive? I mean, I think some of the companies are trading low book value. Okay, so, but then, when will it go up? I've been going on averaging down for the past maybe 8 months. It's still flat. I would say maybe it is a matter of, because the confidence is not back. Once the confidence is back, it's a different story will go back up. And I do believe in fundamentals, but sometimes it's just stretched too long. It becomes value for just a little bit too long. People get tired and exhausted, Many of my clients say, wait a minute, how come? I do believe that, yes, it's very inexpensive right now in China. How I look at it is, how far can it still go down? All these companies are doing so good, the sales, how can it go another 50%?
Okay, so who wants to take the...
This is how I look at it.
Yeah,
But
so...
then how long will China, will investment confidence go back and money go back into the market? That is the key, to go, I do believe that, so that will be my take on China.
I realize that's sort of a rhetorical question, but anybody want to respond to that?
I should have studied psychology and not engineering. I think that for the companies that are in trouble and legitimately so, I think it is very possible for them to continue to drop. I think that to Valerie's point earlier, if you have a local team that understands out of those 300 or so Chinese companies that are listed on NASDAQ or on foreign exchanges, which ones are the best ones to invest in, I think then you follow David's guidance and find those companies and invest in them. In our case, try to take them private. In your case, put your clients in those companies. Because I think if you follow that rule, then when market sentiment does change, and it's anyone's guess when that might happen, then you'll see this flip just as it has historically back to the positive. What we've done is just from a conservative basis been assumed in our analysis, internal analysis for our investment discussions, that only Chinese companies we will assess an opportunity to go public in China, and likewise for U.S. But we would love for there to be more options, and I personally hope that day comes soon. But I can't predict when that might happen.
Well, and I think you can't ignore that there are macro concerns, right? So if you're concerned about the growth rate on a macro basis in China, it becomes beyond. I mean, there are obviously valuation questions, but then if you have broader macro concerns about China or the other markets that these companies are serving, that will figure into the equation. And of course, anything that's not trading at zero can go lower. Look at research in motion. Say, there's always lower. Yeah.
Well, Eric's writing about these stocks every day. If you follow Eric on Forbes, at Forbes.com, he often posts as many as 10 times a day. I don't know how he does it.
That's a slow day.
That's a slow day, he says. Anyhow, follow Eric on Forbes if you really want to know what's going on in the stock market. So thank you, Eric, and thank you, the three Davids, David Williams, David Lam, David Chen, and Valerie Leong. Thank you very much.
What is an innovation?
I feel very confident.
Found out that anyone that had a really interesting idea,
usable for everybody.
So finding the fit is very important.
Doing things the right way.
Here, new partnerships, new licensing, new investments in place.
Innovation Dialogue, East meets West in Silicon Valley.